So today I'm going to talk about the UK stocks that I've been buying recently. I'll go through these companies just to keep that transparency up so you know what I've been buying over the last 4 weeks. I used to do this as a regular weekly update, but it just seems like, as a long-term investor, obviously what's going to happen is I'm going to buy the same companies and I'm just going to dollar cost averaging into it. And because I was kind of buying the same companies every week, 2 week, maybe 3 week, I think the content got a little bit stale. So I've switched that now from a weekly update to a monthly update. And I thought what I'd do is I'll separate my UK stocks and my US stocks. So I'll talk about the UK stocks that I've been buying recently today, and then I'll do my US in the next few days as well. So you guys can keep up on the YouTube channel with what I've been buying. But if you do want to know what I'm buying and selling in real time rather than at the end of the month, a bit of a recap, then the Patreon is the place to be. I post my live buy and sell alerts on there, as well as 2 exclusive videos a week on there as well, which is pretty good for £5 a month, I think. And yeah, we'll get stuck into these UK stocks and what I've been buying recently. So there was 8 UK stocks that I have been buying recently. I'll go through these UK stocks. I'll spend a minute or two on these stocks and some of the reasons why I'm buying them. Won't be a full deep dive into it. Number 1 being Catebox. I did buy a bit more Catebox. I think this is a very cheap valuation. I think the company is doing absolutely amazing, and also I pick up a really good dividend yield with this one as well. So it's a complete package with this one. They obviously sell egg-free cakes, and this is actually the stock that's really stopping me from buying Greggs. I think that when you look at Catebox and Greggs, you get the cheaper valuation with Catebox, you get potentially the better growth with Catebox, and you also get a bigger dividend yield as well. So just ultimately, Catebox is the better one. As you can see here, 12 times earnings, 3.7% dividend yield. It is up 7% today, actually. It's having a really good day today. But I think it's a really good valuation. If you look at the past growth, they've got a history of growing through the revenue and the profit. Now, they've had an extreme jump recently as the online part of the business has done really well. But I don't think it can keep up this growth, but still, it does good amounts of profit. I still think the growth is absolutely fantastic. And even going forward, it might not have that crazy amounts of growth, but I still think it's going to grow high single-digit growth. And when you consider that you're getting this business at 12 times earnings, collecting that 3% dividend yield with high single-digit growth, I think it's absolutely amazing. Financial health-wise, it's pretty strong as well on the financial health-wise. You can see here they sit on 8.2% debt to equity, which is really healthy, and they're sitting on 6.6 million cash on the balance sheet as well. So I'm really happy to keep buying some Catebox. In fact, when you look at the recent earnings as well, there were really strong earnings that came out. So yeah, absolutely fantastic. Airtel Africa, I did buy some Airtel Africa. It recently did bring its earnings out and it did have a bit of a dip, but I bought previous to this dip, so I'm actually still up from when I did buy it. But recently it has had a little bit of a pullback, as you can see here, so I'll ever consider if I maybe buy some more shares again. The recent drop in the Airtel Africa share price was to do with their earnings. They came out and said our earnings are absolutely fantastic. I think they grew at something like 20%. Profit was up a crazy amount as well. And all that for 10 times earnings, which is just absolutely nuts. They did come out on that earnings report and say their outlook was a little bit downgraded. They said that they are seeing a few issues at the moment, that it won't mean that growth will be what it's doing previously. But when I think you look at what we're trading at 10 times earnings, it's not being priced that it carries on growing 20% going forward. If this was actually realistically getting priced for 20% revenue growth company going forward at 10 times earnings, it's just insane. So yeah, even with high single digit growth, which I'm expecting from this one, I still think 10 times earnings is incredibly cheap. Picking up a 2.5% dividend yield as well, which is not too bad at all. So yeah, I am buying a bit more Airtel Africa, and potentially I'll buy a bit more depending on what happens with this dip going forward. Next up was Barrett Development. So same again, I think it's a cheap valuation, 7 times earnings. I think it should be a little bit higher. I mean, house builders are never going to trade at crazy high valuations, but even at 7, I think is a little bit ridiculous. It pays a 6.5% dividend yield, so I am mostly getting it in for this dividend yield. However, I think I will get some share price appreciation as well because it is extremely low valued. When I look at Barrett Developments, I'm looking and thinking, well, when you look at the share price here, there's already a housing recession or a slowdown priced in. The stock is down, 37% since January time. So I'm thinking with a slowdown kind of really already, priced into the stock here, and then you look at what's going on in the economy or the housing market, everyone keeps talking about there's going to be a slowdown, there's going to be a slowdown, there's going to be a slowdown, and it's still growing in the right direction. Sure, it's not growing as what it was, which I don't think it can do. There's got to be a point where there is a break in the housing market. It has to have a bit of a cooling phase. It can't carry on going at the rate that it's doing. But when you listen to what the noise is and what's happening, there's going to be a slowdown. But what's being priced in at the moment is a pretty big collapse in that housing market. You expected it to be a massive slowdown, and I don't think we're going to get the slowdown that's priced in. When you look at the housing market at the moment, especially in the UK side of it, we're so short on houses. We're so short. And the thing is when you look at the generations that are coming through, really need to get on the housing market, and they are forced to kind of pay these fees to get on. And what they are looking at for these houses that are a little bit more money is a lot of, I would say, the generation that's coming through actually do prefer new builds. And I think that when you look at these new builds or new build house builders, they have so much pipeline further down the line. And like I said, there might be a bit of a slowdown, but when you look at the slowdown that's priced in, it's just nuts to me. So I'm capitalising on this opportunity to get a quite extended dividend yield at the moment. Next up was SVL Capital. I did buy some more shares in SVL Capital. I look at the drop-off recently in the share price, which I think is a massive drop-off. Since September time, the company's down 84%. Unbelievable. And it's actually, back at below like CV levels and before the CV times, which is just absolutely insane. And I'm looking at this business here and I'm thinking the financials are pretty decent. The first kind of weakness came out in the recent earnings report, which was that the EBITDA losses were going to be a little bit more than what was expected, which, okay, it's not good. But when you look at what was priced in, priced into this marketing company right now is a massive recession. Once again, it's very much like Barrett Developments. You're looking and thinking it's below CV prices. There is going to be some negativity on the financial side with this business going forward. That totally makes sense. But then once again, you look at this sell-off here and you're thinking, well, it's a 729 million market cap company, and these guys are forecast to do like 1 billion in revenue this year. Like, it's going to be insane. And then even next year, we're going to talk about a company at like 0.5 times sales, and it has like 80% gross margins. Like, it's just insane. So yeah, I think this is a massive sell-off in SVL Capital. I think in the next few years we'll at least see this being a £5 stock, which is massive upside from here. And I think in the future we could potentially be staring at a stock that is over 1,000, which is unbelievable upside from here. I think it's one of the gems on the UK stock market. Hollywood Bowl, so I did buy some more Hollywood Bowl. 8 times earnings. Same again. I think this should be a lot higher. I think they should trade at earnings at least 16, maybe up to 20 times earnings. Collect a 1.4% dividend yield on this one. The growth has been absolutely fantastic on this company here. It's way ahead of where it was pre-CV. I think the growth will stay around that kind of 4-5%. Obviously, one of the key things here is they've recently expanded into Canada, so making sure how that Canada launch goes. But financial health-wise, it's solid once again, paid all its debt off on that it has. Obviously brought the dividend back as well. So yeah, I think there's going to be obviously collecting a 1.4% dividend yield and also a decent valuation at 8 times earnings on Hollywood Bowl. And then there's Legal in General. Same again, I think this one should be trading at a little bit of a higher valuation, 8 times earnings. Probably it's not going to be a crazy valuation because it has slower growth, so it's not going to be trading at like 20 times earnings. But even at 8, I think when you talk about that, it's a very stable company. Dividend yield holds around 6% as well, so I think there's a little bit of share price appreciation to have with it, and also collect quite a good dividend. And the next one, the 7th one, was National Express. These guys brought earnings out. They were amazing. They basically had good amounts of revenue growth. I think one of the fastest revenue growth they had. They actually swung to a profit as well, which was really good. There was a lot of talk about execution on new contracts that they've completed, and also potential new contracts further down the line. And yeah, I mean, we've seen a lot of, I think Google said it in their earnings report as well, like the amount of travel searches has increased a huge amount, and the recovery in National Express travel as well has been huge in the last kind of few days. But when you look at the share price, once again, it's a bit like what we're talking about SVL Capital and Barrett Developments. If you look here, it's basically down near the CV lows. Obviously, this kind of June, August time here, that with a lot of these travel stocks, it had like a double dip here. So we had the CV drop, we had the recovery, and then a lot of them dropped again. This is actually, nearly towards that original CV drop here. Not as much as down in this peak CV drop on the second time round, but it's nowhere near where the stock was at, the pre-CV levels. I know there's been a bit of share dilution as well, so it's a bit tricky to compare it to from that point of view. But yeah, it's just for a company here that's now getting very close to where it was, you know, the pre-CV situation, it's got no reflection on the share price. Like, I think this should be now pushing towards like a 250, maybe three poundish, I would say. So yeah, and then the last one was Hotel Chocolat. Hotel Chocolat has had a massive drop off their earnings. You can see here there was a over nearly 50% drop on their earnings report. We made a video talking about it, and so again, you know, you look at this one here, and the drop off now puts it lower than its IPO. So again, obviously there's been a bit of share dilution since then, but puts it into context like how big the drop off was in that earnings report. When we talked about it on the full video, it really came that it was going to make a loss for this year as it adjusted for some store closures and some impairment charges. And what it's going to do is scale back its international growth, but it's still going to keep some of its international growth, and also it's going to focus a bit more on its profitability. So basically, the potential revenue growth will be a little bit slower in the longer term, but the profit will be a lot better in the longer term. However, for some reason, that caused the stock to get punished this much. It was a massive overreaction, in my opinion. It should have caused the stock to go down for sure, maybe 20%, but I think 50% was a massive overreaction from the sell-off here. So I did capitalize on that opportunity to buy some Hotel Chocolat in the end, and I'll probably buy a bit more going forward in the future. So that was just a one little buy that I did recently. So those are the 8 UK stocks that I bought this month. So I hope you enjoyed the video. I'll do the US ones in the next few days as well. I also did sell a US stock as well, so I'll update you with that in that video as well, which US stock it was that I sold. But yeah, that's the video for today. Hope you enjoyed it. Make sure you hit that like button, and I'll see you on the next video.